In this video, I'm going to show you how to do an average true range volatility assessment in Excel, and we're going to use daily, weekly and monthly data with both the Aussie dollar US dollar pair and the Euro US dollar currency pair, and we'll get an appreciation for the volatility in these two assets over different time horizons as we go through. So the first thing to do is open a blank workbook in Excel, and then what we're going to do is actually create and name a few sheets in this Excel file first, which will indicate where we put different sets of data as we go through the process. So this is what a blank workbook should look like in Excel, and if you go down to the first tab, sheet 1, the first worksheet, and right click on that and then click rename, we can rename that to summary and go through the same process for sheet 2, renaming it to AUD USD ATR daily, and the same for 3, AUD, renaming it to AUD USD ATR weekly, and then we can click this insert worksheet button at the end of the tabs to create another new tab, and we're going to rename this to AUD USD ATR monthly. And these tabs are going to represent where we essentially put the data, the price data that we extract in periods that are daily, weekly and monthly for the Aussie dollar US dollar pair. So the next step is to actually obtain the data, and to do that we go to a website called investing.com. So investing.com, and it's /currencies. And from there we can navigate to the US dollar pairs and go to the Aussie dollar US dollar pair. If we click on that, it takes us to a summary page for that asset, and then we can go to historical data, and then it gives us a load of price data for that currency pair. So we want to first extract daily price data. So the time frame here is already set to daily, and we can change the horizon that we're going to analyze this data over. So we want to go back to 2008, the 1st of October 2008, up to the 1st of March 2015. Then click apply here, and it will update all this daily data within that period that we want to analyze. If you scroll to the bottom of the web page, then we have to extract this data in a rather crude way. So what we do is just select from the very bottom of the data table and click and drag to select upwards on all this price data. And then if we scroll to the top of the web page and we hold shift and then left click before date, that selects all the price data and all the column titles there. And then we can copy that while it's selected by pressing Ctrl C, and then go back to our Excel file and paste this into the Aussie dollar US dollar ATR daily tab into cell A1 by pressing Ctrl V, and you'll see that it then dumps all of that price data into Excel for you and in the correct columns with titles. Then what you can do just to tidy this up a bit is click and drag the intervals between the columns to make them a little bit wider so you can see everything and it's a bit neater. So the next stage is to just obtain the data in exactly the same way for weekly and monthly prices for that asset. So if we just go back to the website, we can just change the time frame and leave this horizon the same that we're looking at, the 1st of October 2008 to the 1st of March 2015. If we just change the time frame to weekly and then go through the same process of selecting all that price data from the bottom of the table, holding shift and left clicking before date to select everything including the column titles, press Ctrl C to copy that data, and then go back to our Excel workbook. This time we want to put it in the weekly data tab, press Ctrl V to paste it in and adjust the column widths where necessary again. Finally, we'll do that for the monthly data. So change the time frame to monthly prices, scroll down to the bottom of the web page select all the data again, copy it, and paste it into the monthly tab for the Aussie dollar US dollar currency pair. Again, changing the column widths where necessary. If we go back to the daily ATR tab, and we can run a few calculations now. So in column G, we're going to calculate the high to low range for each period, so for each day. I'm going to name the column high to low, typing that in cell G1, so it heads the column. And then in the cell below, we're just going to use a formula to calculate the high to low range. So that's just going to be in cell G2 equals D2, which is the high, minus E2, which is the low of that day. And then if we re-highlight that cell with that formula in, we can copy that down across all our periods, all our days, by double-clicking this little black box in the bottom right of that cell, and it copies all the data down to the end of our data set, and you'll see that we've got the last piece of data there for October the 1st, 2008. The next calculation that we're going to do is the daily ATR. So in column H, we're going to head this daily ATR. And the formula for calculating this is equals brackets the sum of the last two high to low ranges, the last two periods high to low ranges. So you click and drag over those two cells, G2 to G3. Close brackets divided by 2, close brackets again, divided by the opening price of the first day in the range that we're looking at, so of the previous day, so C3 in this case. And what that's essentially doing is creating a volatility measure that takes into account the previous 2 days high to low ranges and averages them, and then shows them as a percentage of the previous day's opening price. And in a similar way, we can copy that data down by double-clicking that little black box in the bottom right of that cell. And then we've got all our daily ATR data. Now, if we scroll down to the bottom of the sheet, we'll see that there's actually a div0 error in our last row of data here for the daily ATR. The reason that's there is because the formula is referencing blank data before it, so we have no data before October the 1st, 2008, and it's trying to use a formula which needs to reference data before that, and it can't. So all we're going to do is ignore that from the data set, so we're going to delete it. So select that div0 cell and then just press delete on the keyboard. So now we've got a daily average true range volatility number. We want to see how that changes over different time horizons. So we're actually going to use some averages over different time horizons to see how that develops. So what we're going to do next is rename, if we merge cells J2 and J3, so select J2 and J3 there, and on the Home tab click Merge and Center, and then within that just type average daily ATR, and we want to wrap that text as well. And then in cell K1 we're going to look at the periods that we want to average our daily ATR over to get a decent assessment going. So we're going to look at a 1 week horizon, a 1 month horizon, a 3 months horizon, a 1 year horizon, and a 2 year horizon, and converting all those to days, trading days for currencies. There's 6 trading days in a week for currencies, so we'll have 6 days, and then in a month that will convert to 24 days. 3 months would be 72 days, 1 year 288 days, and 2 years would be 576 days. So now we want to calculate the averages over these periods. So we're going to essentially calculate a 6-period average for our daily ATR values and then a 24 period average, and so on. So to do that, in cell K3, we type equals average, open brackets, from cell H2 to H7, which will be a 6-period weekly daily ATR average. For the next one, a 24-day average, very similar process. We just go from cell H2 this time to cell H25, and again from cell H2 for 3 months to cell H73, so it's just the number of trading days in that period plus 1, because we're starting from H2 to H73. And again for 1 year to 289, and for 2 years to 577. And if we highlight all of those cells, so that's K3 to O3, and right click within that selection, then go to Format Cells, Percentage to 3 decimal places, we can get a better idea of how the daily ATR has changed over time, because we're looking at averages over different periods. So the general outcome here is that looking at the Aussie dollar US dollar pair, we can see, looking over 1 week, 1 month, 3 month, 1 year and 2 year horizons, that generally volatility is increased. If you look at a 2-year average daily ATR, it's 0.875%, but as we get closer to the current time, so closer to March the 1st, then we get higher values for the average daily ATR, which represents higher volatility. So next we're just going to do that same process for the weekly and monthly price data that we have for the Aussie dollar US dollar pair. So a simple way to sort of quickly do this is if we copy across these two columns, column G and column H, the high to low and the daily ATR columns, by clicking and dragging over G and H here, that highlights them all. Then we press Ctrl C to copy, and then go to the weekly tab, click on column G there, so it highlights column G, and then press Ctrl V to paste it in. And you'll see if you click on any of the cells, it will show the formula, and it now refers to the weekly data. We're going to do the same thing for the monthly data as well, copying across into column G, press Ctrl V, and that pastes it in, and it's the correct calculations this time for monthly data. We're going to use a similar tactic for copying across our time horizon analysis. So although there's a few things that need to change, we'll do that after. We'll sort of go back and edit that after we've copied this all across. So if you click and drag and select from cell J1 to O3, that'll select all that time horizon analysis that we've done there, and we can just copy it into cell J1 in the weekly returns and into the monthly returns as well. So let's go back to the weekly returns, start with that since we've already done the daily returns. First thing we want to do is edit some of this, because we've copied across a daily ATR, or what's called a daily ATR, but it isn't actually, it's weekly, because we're looking at weekly periods now. So we need to rename this column to weekly ATR. And the same here in cells J2 and J3, we need to change that to the average weekly ATR and change the column width a little bit so it fits. And also, we're not going to look over the same time horizons for weekly data. We're going to extend those a little bit. So instead of 1 week, 1 month, 3 months, 1 year and 2 years, we're going to look at 3 months to start with, 6 months, 1 year 2 years, and 3 years, and adjust the column widths as we go where necessary. And that is then going to convert to a number of weeks rather than days. So 3 months will convert to 12 weeks, 6 months to 26 weeks, 1 year to 52 weeks, 2 years to 104 weeks, and 3 years to 156 weeks. Again, we need to expand some of these columns to fit this text in. And then finally we move on to editing the average weekly ATR formulas. So at the moment it's still thinking it's looking at the daily periods we were analyzing before. So we need to change this average formula by double clicking on the cell and then changing the H7, so the last cell, to H13 in this case. So we're looking at a 12-week average ATR. So that's H2 to H13. And we can move on to the next cell similarly and change this to H27. So it looks at a 26-week average ATR. The same here to 53 to 105 and then to 157. So now we have a average weekly ATR values over different time horizons. So again, we can draw quite similar conclusions to that which we drew with the daily ATR values. So basically, we've seen a volatility increase in the last 6 months or so in this asset, so the Aussie dollar US dollar currency pair. You can see that in the last 3 years, the average weekly ATR is around 2%. That's increased to around 2.5 in recent times. So let's go and do the same editing and analysis for the monthly Aussie dollar US dollar currency pair as well. So first thing, change the column H heading to monthly ATR and expand the column a little bit as necessary. And then change the time horizon analysis to 6 month, 1 year, 2 years, 3 years, and 5 years. And that's now going to convert to a number of months, not days. So let's change this as well while we're at it. So the average daily ATR changes to the average monthly ATR. Expand the column again as necessary. So 6 months, we're just changing to months, so that's the same. It's 6 months. 1 year is going to be 12 months. 2 years is going to be 24 months. 3 years, 36 months. And 5 years, 60 months. And we'll go back and adjust the column widths where necessary. And just as we did for the weekly average ATR values, we need to change the formulas in these cells so that they represent the right number of periods to analyze over, to average over. So we're looking at H2 to H7 at the moment. That's actually correct because we've got 6, we're analyzing 6 periods, 6 months. Then it's going to be 12 months, so we want to go to H13, H2 to H13. And then 24 months, so H2 to H25, 36 months, H2 to H37, and 60 months, which is H2 to H61. Things have changed a little bit, looking at the average monthly ATR in this case. We can see that looking at the Aussie dollar US dollar pair, that actually the 5-year average ATR is quite high. It's the highest. It hasn't really returned as high as that when we're looking at shorter time horizons, so 6 months, 1 year, 2 years. But what we can say is that certainly within the last 1 or 2 years, the currency volatility has still increased because we're looking at the last 6 months here, and just as we found for the weekly and daily ATR values, average ATR values, it's increased in the last sort of 1, 2, 3 years. Now what we're going to do is use a quick method to construct these sheets as we've done here for other currency pairs, and in the example that we're going to use in this video it's going to be the Euro USD. So the quick way to do this is actually to copy the sheets that we've already got for the daily, weekly and monthly ATR periods. So to do that, we're going to left click and select the AUD USD ATR daily sheet, hold down shift on the keyboard and then left click on the monthly sheet as well, and you'll see that sort of highlights all the sheets between those two, which is just the weekly one, as well as those two in white, which shows that they're selected. Then you can right click on that selection and go to move or copy, move to the end of the workbook and then create copies, and you'll see that that's created exact duplicates of those three sheets, so the Aussie dollar daily, weekly and monthly sheets. Next, what we want to do is rename these sheets for Euro dollar, so Euro USD ATR daily, right clicking on the sheets and then clicking rename Euro USD ATR weekly, and the same for monthly as well. And then all we have to do is import the price data for the Euro USD currency pair, and the high to low monthly ATR or ATR calculations and the time horizon ATR calculations will all update themselves, so we don't need to recalculate any of that. So let's go ahead and do that now and extract data first for daily periods for the Euro USD currency pair. So we need to go back to investing.com and go back a few pages, and then within the US dollar majors page go to Euro USD and then click historical data, and we need to obtain the price data for exactly the same time horizon as we did for the Aussie dollar US dollar. So that's going back to October 1st 2008 to March 1st 2015, and then we click apply, and we're getting daily price data for that asset in that period that we want to analyze. Scroll down to the bottom of the web page as we did before. Start selecting from the bottom of the data table, clicking and dragging upwards, and then scroll to the top of the web page and shift and left click before date to select all the data in that table, including column headings. Then press Ctrl C to copy that. Go back to the workbook, and we want to make sure that we're in the Euro USD ATR daily sheet, and paste that with Ctrl V into cell A1, which will paste it across these columns A to F and give us the correct prices for that. And you'll see that it updates the high to low column, the ATR column and the time horizon analysis by itself. Now we just need to go back and do the same for weekly and monthly. So all we do is change the time frame and do exactly the same process, scrolling to the bottom of the web page and selecting all the data. And then we copy that into the weekly sheet, Euro USD ATR weekly, into cell A1. That's updated everything fine. And then the same for monthly price data. Scroll to the bottom, select the entire table, Ctrl C to copy, and Ctrl V to copy into the monthly tab this time. So the final stage that we go through is actually getting all of our time horizon analysis, so monthly, weekly and daily period ATR time horizon analysis for both the Aussie dollar versus USD and the Euro versus USD, and put it all in the summary file, in the summary worksheet, so that we can draw some comparisons more easily. So let's start with the daily Aussie dollar USD prices. So what we're going to do is select from cell J1 to 03, so the time horizon analysis that we've got here. Press Ctrl C to copy that data, go to the summary tab, and then we want to paste it into cell A3. So we're going to right click in A3, not press Ctrl V for this. Right click and paste as values. So that's a special paste option, and it's represented by this clipboard with 1, 2, 3 on it. So we paste as values and edit some of the column widths as we go in the same way that I discussed earlier. Next, we'll use the weekly time horizon analysis for the Aussie dollar US dollar. In the same way, copy and paste as values straight under or in cell A7, leaving one row as a gap. Again, expanding rows where necessary, columns where necessary. And the same for monthly as well. J1 to O3. Paste as values into cell A11 this time. Again, a few column width adjustments. And then what we're going to do is effectively name this data and tidy it up now. So if we select from cell A1 to F2, highlight that and then merge and center this. So merge it into one cell. And then we want to center the text that we're going to write in here and just write AUD USD ATR. So that sort of gives us a heading for all this time horizon analysis. And next we want to go through and change these average daily, weekly and monthly ATR values over different time horizons into percentages so they're a bit easier to analyze. So let's go through and select those in groups. So first of all, the daily average ATR values. If we select all of those, right click within the selection and format those cells as a percentage to 2 decimal places, and then do the same for weekly and the same for monthly as well. It all becomes a little bit neater and easier to analyze. And finally, what we'll do with this set of data, the Aussie dollar US dollar data, we'll give it some borders. So if we select the title, the heading, as well as the first set of time horizon analysis, and then we go to borders, all borders, and we do the same for the next time horizon analysis, so weekly, and the same for monthly data as well. Then we can do the same for the Euro USD data. So we'll pull that in from, first of all, the daily ATR Euro USD sheet, copy with Control C, paste as values into H3 this time. The same with weekly, copy with Control C, back to the summary tab, paste as values, right click, paste as values into cell H7. And then the same with monthly, paste as values into cell H11. And then tidy this up a bit by expanding some column widths. And we'll go through and format all these numbers as percentages again as well. Okay, so that's all those numbers formatted as percentages, and we can now read this data a little more easily. And similarly to heading the other data, we'll head the Euro USD data in the same way. So we're going to merge and center cells H1 to M2, and then give it the title of Euro USD ATR, and also reselect that cell and center the text, and give them some borders as well, just as we did before. So now we can finish up with some volatility analysis of these two currency pairs. And the first point that I want to make is that if we look at the Euro USD pair, we can see that there's been an increase in general volatility levels in recent times, which is shown in all of the daily, weekly and monthly average true range values. And that conclusion is similar to that which we drew with the Aussie dollar US dollar pair, and it's common generally across many currencies at the moment. And what that basically means is that currencies have entered a period of higher volatility, and with that comes greater opportunity to make profit by trading them, but also more risk to go with that. The second conclusion I want to draw is between the two pairs that we're looking at here. So the Aussie dollar US dollar pair is shown to be more volatile over any time horizon when we compare it to the euro US dollar, which defines it as a riskier currency to trade, but again with that there's more opportunity to make money from it. One of the most important points here is that it's clearly shown that there's more volatility in monthly and weekly average true range values across both the assets that we're looking at. And so if we extend our trading horizons, we can take advantage of this greater volatility, and with that there's greater potential to make profit as well over those longer horizons. Lastly, I want to draw your attention to this average true range volatility assessment that we've just done in comparison to the distribution of returns volatility assessment that we did in a previous video. So this is the spreadsheet that I concluded the distribution of returns video with, and what we can see in this is essentially that the Aussie dollar US dollar pair showed greater volatility across all these risk measures that I covered in that video compared to the Euro USD pair. So the outcome is essentially very similar to what we're covering here in our ATR assessment, although the ATR volatility assessment is a little bit more crude and simplified. You still get to the same outcome. So you should find when conducting both the ATR approach and the distribution of returns approach to volatility that you'll get a similar outcome across all assets that you analyze in terms of volatility, risk levels, and opportunity that goes with it.
Okay, so welcome back to the computer screen. Chris drew some conclusions there, looking at Aussie dollar, US dollar, and Euro US dollar, both in absolute terms and compared to each other. But what we're going to do now is just cement all of these conclusions and what we've learned. Now, if we look at the Aussie dollar, US dollar in absolute terms, what we notice that on a daily ATR average, so rolling basis of a daily ATR, we can see that volatility has obviously been creeping up here. We can also see this in the weekly ATR stats, the average weekly ATR stats. Volatility has obviously been creeping up on a weekly basis, and it's been creeping up on a monthly basis. Now, what does this mean? Well, if the Aussie dollar on a monthly, weekly, and daily ATR volatility basis has been picking up consistently, it just means that opportunities and risk are higher relative to the asset itself historically, which is perfect because in absolute terms, it means the opportunities and risk are higher. So as professional traders, this is something we really like to see. What about if we look at this on a relative basis? Well, if we look at our table and we sort by a daily ATR, the overall table is our tradable set, so all our tradable set currencies, currency pairs, and worked out on a 1-year average. So we're looking at the rolling daily ATR, rolling weekly ATR, and rolling monthly ATR as a 1-year average. And when we sort by daily ATR, we can see that the Aussie dollar, US dollar has the 5th highest daily ATR of any US dollar cross. So if we look at if we just zoom in on the US dollar crosses, we see that ranked number 1 is the dollar ruble. We then have the dollar South African rand, dollar Norwegian krona, and dollar Swedish krona. And we have the Aussie dollar, US dollar here. So it's, in terms of dollar crosses, at the moment, it is ranked as number 5 on the volatility scale. Now, what you also notice on the volatility scale in terms of dollar crosses is the propensity towards volatility in commodity currencies. So we have the ruble, the South African rand, the Norwegian krona, and the Aussie dollar. 4 out of the top 5 are what we would term classic commodity currencies because their exports are highly concentrated or highly dependent on basically 1 or 2 commodity prices. So this obviously differs from currencies like the euro and the pound, in which the export markets of both Europe and the United Kingdom don't solely depend on the value of one or two commodities. Their exposure in their export markets is very diverse to a multitude of variables. So if we look at the Aussie dollar, US dollar over a weekly ATR period, we can see similar results. We can see that the Aussie has the 5th highest weekly ATR of any US dollar cross. And we can also see similar results in terms of volatility exposure to commodity currencies. So in the monthly ATR stats, we again get similar results, and we have the Aussie dollar, US dollar as the 6th highest monthly ATR of any US dollar cross in our set. And the numbers, you can see, become more compelling as we increase our time horizon. So on a one-day basis, a daily ATR, 1 year average, we're looking at a 0.811% ATR on average per day. On a weekly basis, we're looking at a 1.959% average per day. And on a 1 month basis, a 3.976% move. Okay, so let's try to look at this in the bigger picture. In terms of looking at this in the overall process, in the context of the overall process. For the purposes of the Professional Forex Trading Masterclass video series, the Aussie dollar, US dollar, is a really good currency pair example to show you, because it's great in terms of demonstrating how to go about the entire process and also constructing trade ideas. And let's have a look at the reasons why we would even consider using this as an example in the video series. Well, we've obviously seen that it's volatile, but let's have a look at some bigger picture reasons. First of all, we want to use the US dollar. So concentrating only on the US dollar side, because it's the world's reserve currency. And you need to know the macroeconomics behind the United States. And going through the whole process using the US dollar and the data of the US macro is going to help us to establish a template that can be applied to any country. You'll see as we go through the process, there's many, many variables in the idea generation phase, which we move on to next. And all of those variables in principle can be applied to every other country. And the US is just a great place to start because it's the world's reserve currency. So we get a couple of things from doing that by default. Also for the Professional Trading Masterclass video series subscribers, so the PTM subscribers, what this is also going to do is help you form your worldview and also your views on the stock market and stock markets around the world. So we get a number of things when we just use the US dollar side of the trade. We get a lot of things that we can take in terms of usefulness in the overall bigger picture of the entire systematic process. The second thing, when we look at weekly and monthly volatility, the Aussie dollar, US dollar is somewhere around the middle of the pack. You'll have seen on the tables on previous slides that the Aussie dollar, US dollar for weekly and monthly volatility comes around the middle of the pack. So at any one time in our set, we can see that there's probably going to be more volatile and less volatile pairs in this tradable universe. So the numbers we look at are a great anchor to the average opportunities across the entire set. So what that means is that if we use the Aussie dollar, US dollar as an example, we're looking at the average of really all the opportunities and all the risk across the entire Forex complex. So in terms of your learning and understanding about the overall Forex market, Aussie dollar, US dollar provides us a really good example. Also, when we think about these numbers and we interpret them correctly, we've looked at the volatility and we can see almost straight away that daily volatility is extremely low in absolute terms for any Forex pair. So when we compared euro dollar against Aussie dollar, if we just look at them on an absolute basis, objectively, on our daily analysis, we can see that returns are extremely low and extremely unpredictable. When we move out to the weekly and monthly timeframes, we can see that the volatility is much higher. And if we can combine this with fundamental analysis and predict fundamental trends over longer time periods, then we probably stand a much higher chance of making good money consistently and actually leveraging these returns. So if we look at our intended time frame at 1 to 3 months, which is the professional trader and hedge fund manager approach, we can actually make significant returns, because with Aussie dollar, US dollar, with monthly volatility of around 4%, if we capture this over a 3-month time horizon, we could be capturing a minus 12 to plus 12% volatility and risk. And in currencies, this volatility can always be leveraged. So the first point is start thinking of this in terms of months. So 1 to 3 months and longer. This minus 12 and plus 12 return over a 6-month period, for example, that could be minus 24 and plus 24 if Aussie dollar, US dollar moves in one fundamental direction over that time period, which is great for traders because that will be a fundamental trend. And if that 24% return can be leveraged, we can obviously make a lot of money. Now, we looked at leverage, margin, and exposure earlier, and we came to the conclusion that it's best to actually set your own gross exposure levels and actually put more money in your trading account, potentially, and choose your gross exposure level, thus choosing your own leverage level. And it's quite an easy conclusion to come to, that if you get a 12% return over a 3-month period and you leverage this 8 times, so if you put a larger amount of money into your trading account, let's say a $25,000 deposit on margin, and leverage this the equivalent of 8 times, so you have a $200,000 exposure, you can actually get this 12% return on your $200,000 exposure. So getting a $24,000 return with $25,000 in your trading account, therefore getting the equivalent of a 96% return on margin. Now, what we've done there, we'll be looking at in more detail later, but that principle is pretty obvious. All we're doing here is capturing volatility because we're looking at longer term time horizon. And instead of trading every single day and making nothing and guessing which way a currency pair is going to go, we establish a fundamental trend. We deposit a much higher amount of money on margin. We take the position and we leave it. And we capture over 3 months a much higher return. And in doing so, because we chose our own gross exposure and deposited more money on margin, in the meantime, we don't have to worry about the volatility, and it can just be left for months on end in order to capture the volatility. And what did we get in this example? Well, we got a 12% return on exposure, so 12% on the 200,000, and we got a 96% return on the $25,000 deposited on margin. And we didn't do anything. We just took one position and left it. And this is exactly the professional trader approach. We don't need to trade every single day in Forex, because if we get the fundamental move right, we capture the volatility and the trend over a longer time horizon, and we're not forced into trading every single day for no reason. Now, what you need to do is remember to do your analysis on volatility in terms of opportunities and risk all the time, and be realistic given the evidence. The great thing about this is that if everybody was realistic, there'd be no retail Forex day traders, and therefore no dumb money. The fact that you're now going through this process, and we can guarantee that not everyone in the world will do it, it means you're now at a fairly significant advantage. The smart money, so professional traders and hedge fund managers who understand where opportunity exists and how to capture it, we basically need the dumb money to exist in order to capture the opportunity. The process that we've been through in order to analyze this is the distribution and ATR analysis. The volatility analysis by looking at distributions and ATR is really fundamental to a Forex trader's education. And what it does is really help to cement the foundation on which we can always rely on as a head check to our own expectations of opportunity and risk. So we don't have to rely on other people's opinions and pseudo facts about the Forex market. We can just use this process to check everything objectively at any one point in time. By doing that, we just cut out all the noise. So it's a shortcut to finding out where the opportunities and risk are. And this really is part of the wider foundation of understanding that includes the whole systematic process. So systematically assessing the opportunity set, how currency regimes actually work, the infrastructure of the Forex market, and all of those basic computational methods that we use regularly in the Forex market. So it's part of this foundation and understanding of how this particular market works that we've been through in the first part of the video series. So now what we're going to do is go back to the desk for a quick recap of video 6 and a further wider recap of the foundation before we move on to starting the entire idea generation process.
Okay, so welcome back to the trading desk. So what did we pick up there with average true range? Well, what we did pick up was that average true range is another method, so a complementary and a substitute method to analysing the distributions of returns. And what do we mean by complementary? Well, you can use both ATR and distributions to basically check each other in terms of analysing currency volatility in absolute and in relative terms against each other. In terms of substitution, you realise as well when you look at the daily ATR that the results are actually quite similar in terms of their magnitude to the daily data that we obtained in the volatility analysis when calculating statistical distributions of returns in currencies. So it's a slightly more cruder method, but it can be used to complement or substitute distributions. Now, when we looked at the data itself, we concentrated on Aussie dollar, US dollar, and we extended our analysis from daily to also include weekly and monthly volatility analysis. And the conclusion that we really got to was that if we start looking at weekly and monthly analysis, when we work out the volatility, we can see as traders that there's a much greater opportunity and risk to trading over weekly and monthly timeframes in Forex. So rather than when we look at the daily data and compare, and we look at very similar daily data in terms of ATR and distributions, the daily data conclusion that we got to when we looked at distributions was that the opportunity to make or lose money on any given day in history in both Aussie dollar and euro dollar is very, very small. And this doesn't change when we do our ATR analysis. But when we extend out to weekly and monthly timeframes, the opportunity looks far greater, and also the risk. So when we got to the monthly data, we saw that we could actually capture a monthly return historically on average on a rolling monthly basis of around 4%. So when we're looking at 1 to 3 month timeframes, we can see that we can capture a 4 to 12% plus or minus return or loss. So this is exactly what we like as professional traders. This is something we don't need to be frightened of or scared of. This is exactly something that we need to embrace. And we realize that if we just take a very sensible approach, so taking the mentioned approach from when we were looking at margin, leverage and exposure of, for example, putting a higher amount of money in our trading account and choosing our gross exposure level, thus choosing our leverage level, and that ends up being much lower. If we take this more common sense approach and capture this volatility over longer term timeframes, we can actually massively increase our chances or potential chances of making money. So instead of flipping a coin and hitting the button every day and buying and selling every day and making zero, what we're doing is actually the opposite, going for longer timeframes and putting a position on and just leaving it to capture the volatility. Now, when we come to leverage, what we talked about was if we leverage this trading strategy over here on a daily basis of hitting the button every day, tossing the coin, buy or sell, choosing a direction and getting out and making zero or making or losing very little, if we leverage that situation, we're just leveraging returns that don't exist. But if we leverage this situation over here, we're actually leveraging returns that actually exist. So it's a very different approach, and it's very key to understand that. Now, when we look at the ATR itself, the other method is distributions. You can actually use weekly and monthly data and use the distribution method to get very close to the same answers. So in our advanced computational methods section, the things that we've really learned is how to analyze volatility properly and how to interpret it properly. That's really key. So in terms of interpretation, in our next stage, we're now going to build on this foundation that we've achieved in terms of our overall knowledge of how the Forex markets work, and go on to build our systematic process of how we actually generate ideas. So let's move on to video number 7 and start looking at macro fundamentals.